Good morning, good afternoon, everyone. Welcome to another panel discussion of the Global Trade Review Asia 2021. I'm Gabriel Petrus. I'm Deputy Director for Global Partnerships and Development at the International Chamber of Commerce. I'm speaking today from Paris. I'd like, first of all, to thank all friends and colleagues from GTR for this invitation, Jeff and the team for having invited me to have you today as the moderator of the session. Our panel today is an industry debate. So I'm very happy actually to be joined today by a great lineup of speakers and colleagues from all over the globe. Claire Thompson, Executive Vice President for Enterprise Partnerships at Mastercard, together with Frank Wendt, Executive Chairman of FQX AG, John Galani, CEO of TradeFlow, and Tom James, CIO and CEO of TradeFlow Capital Management. I think the debate today is very important in time actually and relates a lot with the work of the ICC. We know with the sharp increase in the cost of working capital and ongoing concerns of SMEs or related extended payments, there is an estimation to be the tune of, we're actually talking about $16 trillion worldwide in terms of gaps in terms of capital for SMEs. We know that SMEs have often borne the brunt of recent financial pressure. So if SMEs are seen as a crucial factor in economic growth, should more effort be coordinated across the trade ecosystem to support them to have more access to finance? So that's the very important statement of today's discussion. And we actually discussed some of the transformational partnerships our colleagues and the speakers are actually leading with their institutions. From creating interoperability from banks to fintechs, to supporting SMEs via risk-sharing programs, as well as the regulatory and market challenges that are related to that. This will be a very dynamic debate, so I'll stop speaking now, and I'd like to give the floor to each one of the speakers to do a 5-minute introduction remarks on what you're doing actually to support SMEs to have more access to capital. I'm happy to start with John Galani, who's the CEO of TradeFlow. John, it's over to you.
Thank you very much, and hello to everyone. So John Galani, Chief Operating Officer for TITUS. TITUS is a fintech platform for trade finance. And the way we started is we started as a principal business in Singapore. And what we saw the last decade was really a retrenchment from the banks, especially the European banks that tended to have a larger set of expertise in international trade finance. To a certain extent, it's perfectly understandable. 20th century trade finance was mainly Atlantic Basin. 21st century is obviously Asia. And but the other problem is that we're talking about a single currency, which is always used across Asia, which is the dollar, which is not an Asian currency. And so if you pile up the risks of taking a supplier country, which is a sovereign risk, a credit risk, an FX risk, you take a mid-market player, you as a trader, as an intermediary, and then you take a consumer country such as maybe China or India, and then you pile in the same three risks, again, sovereign, credit, FX, and you layer this across 3 different jurisdictions. With the logistics in the middle, it becomes extremely, extremely difficult. Now, the interesting thing is, this is not the first time that in finance, things have become too difficult or too complex. And usually you see the US that has gone through this in mortgages, for example, and in other fields. So what is happening in trade finance, we feel, is not something that is new. It impacts, obviously, a great deal because of the size of the trade finance market, but standardizing, understanding the problem, standardizing the response is what we in TITUS are trying to do, layering a tech platform with the human layer of expertise. You cannot do tech without a human expertise, just to be clear. It'll never work. Otherwise, you get Betamax versus VHS. You have a better technology in Betamax, but you cannot roll it out in VHS 1 for the people that remember these things, unfortunately for me. So that's our background as TITUS. We are NASDAQ listed. We went live in June 2019 with a trade discovery module, which is a ticketing. We moved to a trade finance module, which is the funding, which is the key part, I think, of our discussions. And the trade finance, I think, is something that we all on this panel are looking at from different angles on the SME because of these issues. Now, I'll let the other panelists talk about their angle, but what I would hope is that you all see that everybody as an industry is trying to tackle this in as best a way as they can. And there is not going to be one single solution likely, neither is there going to be one single winner. So as a group, as an industry, I think such panels, such discussions, and such debates are critical with the feedback from industry participants in order for the whole industry to move forward. Thank you very much.
Thank you, John. That indeed, I think it's about building like win-win partnerships and enabling this level playing field for SMEs to have more access to finance. And again, I think you covered really well the market trends from our perspective as CEO of TITUS. Actually, the debate, the way we're dividing our debate, actually, each one of the panelists are kind of covering one of the key pillars of this discussion. We're now moving to my colleague Tom James, who's CIO and CEO of TradeFlow Capital, to actually cover a little bit more about the experience of working with SMEs on the ground. And I think, John, we're actually working with you hand in hand with the ICC on different partnerships. But again, over to you.
Thank you, Gabriel. Yes, and it's great to be here on GTR Asia. So our experience started in 2016, looking at the trade finance gap, which all of us here are sort of addressing in some way, shape, or form, and really looking at why the banks or lenders couldn't lend to many SMEs on transactions. Commodity import-export transactions is what we focus on, and why the SMEs couldn't borrow. And so in the end, we found that it was often to do with data, ultimately a lack of data, either on the SME, so they didn't fit for sort of a lending approach, or the deal size were just too small, and as banks have been delevered in trade finance over the last decade or so, we've just seen that trade finance gap getting bigger and bigger. So we don't compete with lenders or banks. We fit in a space where we can actually complement and collaborate with banks to bring extra security and even in some cases change the credit risk profile of a transaction for a bank by being a neutral principal. So our fund basically found the best way to help the SMEs and also create an interesting investment product was to buy the commodity for the SME companies. They could be a trader, distributor, an end manufacturer sometimes, because actually what they need done is just to move something from A to B. So it can actually they can add value to it somehow. And so that's what we've been doing for the last 3.5 years in our TradeFlow funds, is buying the commodity from their suppliers and moving it and owning it. So it's much lower risk for the investor, and we're really focused on the underlying transaction, not the credit worthiness of the counterparty. And so that hopefully is opening up another area of this problem and issue, which we're looking at, we're all looking at today. So that's the key thing, and obviously recently we've been able to also turn from just our fund also into an investment grade product, issuing senior notes with an investment grade rating. So we hope that working with lenders and other financiers, we can continue to unlock the liquidity really in the market and help SMEs out more around the world.
Thanks a lot, James. That was very Tom James. Sorry, that was very insightful. And actually, what you covered is an important aspect of discussion, which is about we're not competing like fintechs and banks. Actually, you can create a collaborative environment. And that's actually the point I'd like to bring in now with Claire Thompson, who's Executive Vice President, Enterprise Partnerships at Mastercard. Claire, over to you. I think you're actually covering a very important topic on the collaboration and interoperability between banks, fintechs, and what Mastercard is doing on that. So over to you.
Thank you, Gabriel. And great to be here, albeit virtual. Maybe next year. I think we, what we've all been talking about is kind of addressing the gap. And clearly over the last couple of years, the need, you said it, Gabriel, in terms of the funding gap, reaching enormous numbers of like 16 trillion. And I think the positive is we have seen a real kind of impetus around partnerships, right? And I think that's happened in a number of ways over the last few years. Clearly, we talk about banks and fintechs. Fintechs often really are enablers, whether it's the technology, the platform, the agility that comes around that. So I think the whole mindset change and the need to partnership has really kind of come forward over the last few years. Clearly, it started pre-pandemic, but that's a positive. I think to really enable that, what we've seen is then looking at how we partner, right? So I think we've seen the rise of platforms, digital platforms, but the difference now is those digital platform connectivity, connecting and creating the interoperability. So they're not existing in as islands in isolation. So for us, it's really important that we enable the connectivity. I think the advent of open banking, right? So some things in regulation are positive, right? So the opening up of data, democratizing data. Tom talked about it in the context of really SMEs not having a history around kind of their trading history. So for us, we're really seeing it, how we can play a role clearly on the payment side, but enabling early payments, enabling access to financing at a much better rate. We can all get financing, but it can come at a severe cost. So really with open banking, it's about enabling kind of access to that data. So going in and looking at who's trading with who, looking at the payment history, they've been paying on time, what's the quality of goods. And from there, you can kind of build up what we call an SME credit passport, right? And for us, that really starts to open up kind of access to affordable financing. So that for us is a huge focus, working with fintechs, working with the banks. And we've tried to also take a vertical approach. So in looking at this, obviously the B2B landscape is humongous, right? So, but if we think about, are we looking for data and looking for who's trading with who? We're starting with the platforms where you actually see the supply chain happening and then bringing in the financing and the payments and layering on that. So you've actually got all the actual history of who's buying with who and what the quality of the goods. So for us, it's an end-to-end approach. It's using open banking and what we call digital data-driven financing. And we're doing that in agri with a number of players looking at how we do that across the agriculture industry. For us as well, freight and logistics is a massive focus. So what we've really seen there is it's not really just about, it no longer can be about just focusing on costs and the movement of costs in terms of freight and logistics. It really is now looking at supply chain resilience, right? And that's what we're seeing. And so to enable supply chain resilience, you really have to start creating this interoperability using the data. And another piece that we're also looking at is we're applying our blockchain solutions. So when we're linking in that data and using the blockchain to track the flow of goods. And also once we know the goods have arrived, we can do payment triggers to actually pay and also pay early. And the ideal is actually you can even finance early and with the right risk appetite, you do that on a pre-export basis. So I think it's digital and technology, but in isolation, you really have to create that interoperability digitally and have and continue with the mindset around partnerships.
Thank you, Claire. That was great, and I think you touched a point which Tom actually also referred to, which is about enabling the environment for SMEs to actually have speed access to finance, not only SMEs but the whole, how we can enable sound policies and sound tools for better supply chain resilience. And I'll turn to Frank Wendt, who is executive chairman of FQX, because we know that there's a challenge on regulation, of course. I think we cover different pillars, from partnerships, from actually operational aspects of working at SMEs on the ground. But what are the real challenges in terms of standards and global rules that need to be improved in order to enable this win-win environment for SMEs? Frank, over to you.
Sure, thanks a lot. Yeah, FQX basically is a company that came from an angle, also the realization of the trade finance gap, but also the total cost of a transaction in trade finance. We came from a legal perspective. We looked at the financial instrument landscape that is available to corporates and banks. And it's clear it's very heterogeneous, it's extremely complex, due also to different jurisdictional regulation and circumstances. And we approached the problem of looking back and seeing what are actually the most efficient trade finance instruments ever been seen. And then we came to a certain class of securities which has been almost forgotten, which is the negotiable instruments. But we looked at the negotiable instruments and we basically developed it in a legal framework which is based on true law. And you might have heard of the model law on electronic transferable records by UNCITRAL. But in fact, the United States had already something similar called the Uniform Electronic Transaction Act in 1999. So they actually already use it today in the mortgage market to have electronic notes. And Freddie Mac and all those guys are buying those fully electronic financial instruments. So the idea fundamentally is to take financial instruments in the trade finance arena and make them fully digital. We do see a lot of digitalization in terms of process improvement, workflow optimization, automation. There is a limit to this, however, because you are shooting PDFs forth and back and so forth. To actually make the financial instrument itself electronic is the next, from my perspective, the next phase. And coming back to the issue of regulation or legal basis, I see three levels. Number one is the legal foundation. And we see now in Singapore in particular, the enactment of the Electronic Transaction Act enables bills of lading, bills of exchange, promissory notes, warehouse receipts that are all basically endorsable or intransferable, are able to become fully electronic. And that obviously most likely will require some form of blockchain technology, which we are providing to actually then with a few clicks enable that financial instruments can be transferred, title can be transferred within seconds. So that's a focus of FPX. In terms of legislation, we see that the UK, or England and Wales to be precise, are adopting and amending the 1882 Bills of Exchange Act. So the 1882 tells you everything. And we hope also that we can see that in Germany, we're working in the working group there to also adapt it as one of the bigger export nations to also adopt the model law. I think the G7 has actually already made a commitment to actually adopt that same model law. So that would mean there is a trend coming which is helping SME financing. Why? It actually drops the transaction costs significantly. We do not solve everything. We still need some data, as Tom mentioned, in terms of credit data. This is still the topic, but identification is probably also easier coming along with the same effort. And I think that is hopefully then a way with one infrastructure to transact globally in a way that is really providing more transparency, auditability, but more importantly, dropping the cost per transaction to a level that SME financing is actually affordable for banks and financiers.
Thank you, Frank. That was really, really interesting. And we're now open for questions from the audience. We have already some questions coming to, and again, I'll open to all panelists. So actually read the question and feel free actually to bring your insights. This first question is on sustainability, of course, which just came out from COP26 and how sustainability and trade finance are relating to each other. So actually, I'll read out the question. So new research by HSBC and Boston Consulting Group estimates that decarbonizing global supply chains, which means 80% of the world's total carbon emissions, requires as much as $50 trillion investment into SMEs, which will be 2.8 trillion a year between now and 2050. Bearing in mind the existing trade finance gap, is there any reason to believe there is sufficient leadership in the market to achieve such a lofty goal? So who'd like to take this question? John, over to you. I think you're in mute.
Thank you. Yes.
I hear you.
So the first thing to say about ESG, so it's not only sustainability, obviously, is that there is no explicit leadership. However, there is a community of thought that is spreading about this topic. I know we all criticize that lack of leadership, but I think it's a testament that the whole world can come together and take decisions. And just on any COP, whether it's a 25, 26, or the others are coming up, it's a work in progress. So what we see from our funders is they know what they don't want to do. I mean, most Western funders will not touch coal. Let's be very clear, and that is a problem in by itself. But at least it's a problem on a specific commodity. Then they don't know what to do because ESG is understood by everyone, but is very, very difficult to measure, and it's even more difficult on an SME level because the smaller the companies, the greater the number of links in the supply chain. If you have one company that is vertically integrated, it can do everything, it can measure everything. So this is highly problematic, and measurement, I think, is the next frontier. And measurement has to be quick, efficient, and repeatable. And that, frankly, is the problem that SMEs face in general. Quick, repeatable, standardized information set, whether it's ESG, whether it's the actual funding. And so I just want to give an example which can be applied to ESG, but which will take years to achieve. If you take ESG and you take a platform, what does a platform really do? It standardizes an information flow because you are forced by virtue of using a computer to tell a computer exactly the inputs in order to get the outputs. So TITUS works like a funnel of information taking data. And so at the end of it, one hopes with a digital platform, whichever one it is, that you speak a common language. And that's the key, a common language. So ESG for SMEs, that commonality of language of results, numerical results, will take an awful long time. But we can see from our funders, which are, and just again to summarize, what we are trying to do is Western funding for emerging markets growth, because there's higher yield in emerging markets, and there's an arbitrage opportunity between the risk and the yield, which you lower by standardizing information set. That the Western funders all want ESG. They have no idea how to achieve it, to be perfectly honest, but they all want it. So work in progress, it'll be even more difficult for SMEs, without a doubt. Everybody wants a piece of the money that is theoretically allocated. Not everybody will get it, but if you just sit there and doing nothing and request it, you won't get it anyway. So please, let's focus on mapping out what ESG is, mapping out the data set, and frankly, digitizing that data set to get to a result which can then be used for the funders.
Can I just add on to what John's saying in terms of, I think that's spot on. And what I would say as well, it's more tactical, but it's certainly more near term. We've heard, with COP26, it's all about what the targets, achieving targets. I think as each and every company, we can set targets around inclusion and sustainability for our own performance and our own kind of tracking. Are we meeting So I think, from a Mastercard standpoint, we'd already set a target of including 500 million individuals and companies into the digital economy. During COVID, when we could see what was the massive disruption, what was happening, particularly in the SMEs, right? Whether that was getting access to funding, which clearly became an acute need, even more so than it was pre-pandemic. But there was, they needed to also get online. Many of them couldn't trade anymore, so get digital. So for us, it was like that was the perfect time and the necessary time to increase our own targets around inclusion and make ourselves accountable and drive action, right? Because there's action that's going to happen when we all join together, and we need to continue to do that. But if each and every individual company does their own thing, makes themselves accountable and measures, because you can measure your own, right? It's sometimes difficult to measure other people's, right? Because you're relying on getting access to data or that data funneling. So we increased ours from 500 million to 1 billion by the end of 25. And that goes throughout the whole company. And that's, in terms of how people are measured, how the senior management is measured, this, the ESG piece is critical, but it is actually measured. And so it's not about kind of waiting for someone else to do it. The action has to be, within your own company, that you make yourself accountable and set yourself real targets.
Yeah, and I think to add to what Claire said there, I mean, that's what we're trying to do is since we have all this data on the commodities, where they come from, sometimes even how they grow, and even sometimes what fertilizer or what chemicals were used, and whether there's poverty alleviation with the cooperatives. So we've got a lot of data there. So I think, John and Claire both making good points that a lot of their challenge is measuring the ESG-ness of things on a consistent basis, and trying to do that. But going a step further of making ESG sustainable in itself, so making the business of measuring that actually pay for itself and also add value. So because we're also talking about trying to change behaviors. And so, dealing with SMEs in Africa, for example, being able to show them that, listen, okay, if you do X, Y, Z, there is a value in there. And here's a formula that actually shows that if you do this, if you change behavior in your business process on the ground, if you're reducing your carbon emissions, there is value in that. And certainly we already see some of the big manufacturers, I won't mention them here, but they're very public about it, that they want to buy at least 50% of their ingredients from particular sources and things like this. It's great that, like Mastercard, ourselves, TriTerrace, we're able to, as third parties, as observers and almost as not quite sort of auditors, but certainly, we're able to show provenance of the data and share that independent information to the buyers who, have indicated they will pay a premium. So for the farmers or the growers or these people, as just one example, they could actually, we're getting more money by actually doing ESG ourselves. And I think that really helps change, make long-term changes for the better. So that's what we're trying to do there.
Yeah, I'm sometimes a little bit fearful in a sense, S and G. That's still not 100% clear in my view. And I'm also looking for I just wanted to have a bit of a cautious approach to ESG in a sense. Obviously, trade finance gap and SME financing is addressing the social side of ESG in itself, which is an important factor. Where I'm a bit more cautious is the lack of standardization, understanding what ESG actually means. Obviously, investors in particular that are promoting ESG financial instruments or financial products need an objective reference to make something an ESG product or any financial instrument they're marketing. It needs to be auditable, it needs to be traceable in order to make that product, let's say, stand in the marketplace and have also good reputation. And that is something, and I'm coming also a bit from audit firm perspective. I know that as soon as this happens, then costs are piling up. It needs to be audited, it needs to be local. And I'm a bit fearful that this could be counteracting our objective of providing SME financing, that it could at least, I'm not saying it will, but the risk is there that it will increase transaction costs. Because that an investor says, I need to know that this SME is in a ESG bracket of my investment policy. And that needs to be then proven, and that will potentially lead to costs. I'm not trying to put salt into the soup, but I'm a little bit more cautious of how this will be implemented, because at the moment it's obviously fluid. The discussion is fluid. They are not standards. And of course, we need those. We need ratings probably, and questions are coming up. Is it part of the credit rating, another category, which then obviously goes to pricing? But sorry, that's just from my perspective. It's a very interesting discussion, but it's also something we need to look how it goes in the future.
Thank you, Frank. And again, I think thank all the panelists because I think you have actually brought different perspectives. And if I could summarize this debate on ESG, I think there are three challenges that you point out. The first one, actually, John brought the need to set common standards, a global standard on. I think this refers to what Frank mentioned about what is ESG and how this applies to SMEs. The second challenge is on the change of behavior, how we can create financial products, for example, and actually primes that actually benefit SMEs that are taking this direction. And third challenge, I think Claire pointed out that the role of supply chain leaders, because I think and that's our perspective as ICC as well, we do believe that supply chain leaders, they have a big role on enabling this environment where SMEs will be able to measure their performance and have benefits about them. By the way, the ICC, we just launched a platform called SME 360X, which helps SMEs to measure the natural capital impact. So we're measuring 5 variables from carbon emissions to land use and waste generation. But there's a challenge, and again, that's another question that just came from the audience, how we can make sure that those green accounting standards will be effectively verified by third parties. So I think this is an ongoing debate. Of course, the first step we should take to improve sustainability standards, even in trade finance, is to measure. So we understand we can't circumvent measure. I think it might be a price all of us will need to pay, and to pay less, perhaps we should look for sound regulations and a global standard, a common standard on how to measure specifically for SMEs. And at COP26, there was some interesting developments on green accounting, especially for big financial institutions, but it remains, there's still a gap, and we should still address that for SMEs. We still have 15 minutes for debate, so I'll take other questions from the audience to the panelists. I'll change a little bit the focus to more specific question on trade receivables. So to support financing SMEs trade receivables, a couple of panelists mentioned it's important to focus on underlining trade transaction versus the buyer's credit. Traditional banks and traditional financial institutions do not yet subscribe to this view. What does the panelists, what do you think that needs to be done, or what data points can be provided to help traditional banks shift towards this mindset? So I'll open again to all panelists. I think John wants to start.
Yeah, sure. Actually, it's a very good question. The key thing is that you've had a shift over decades in different products and different categories from relationship to transactional. 50 years ago, my parents would have gone in their suit and tie. That's the example I give, to get a mortgage. And they would know their banker, their local banker, very, very well, and vice versa. Today, if I want a mortgage, I'm based in London. I'll never meet anyone. So what you have is a shift from a general relationship type to a more specific transactional type. And the same thing is occurring around the world for one simple reason: you can measure risk better. And if you can measure risk better for a given loan, you can standardize and stack them high and you can lend more money. So over the last century, the banks have grown in leaps and bounds because they've been able to standardize that system. Now, when you are talking about the risk profile of a transaction, or specifically on receivables, which our platform does a heck of a lot, the key thing from a funder, and it's not only a bank, so we just need to be clear, whether it's a bank or not, everybody's shifting to that model. It's just simply that the funds were able to shift because they saw the gap, and the banks were constrained by the Basel regulations and the fact that they, it's difficult to cannibalize one's own business model. The shift is, do you have performance risk compared to credit risk? If you have credit risk, is it pure credit risk, or is there an underlying collateral? And if there's an underlying collateral, what is it? Each and every transaction has a specificity, and on the receivable side, you tend to talk about a lack of collateral usually, but a specific credit risk on the counterparty. Whether you take it as a supply chain finance, where you look at who's the larger, the lower risk, which is in the supply chain finance is the buyer, or you have receivables, then to each their own. And so, from our platform, we offer both models, but the risk has to be very well defined. Now, the problem with SMEs is lack of data. So I'll just stop in 10 seconds. And one of the things that SMEs need to be able to do is to be able to provide data such as historical payment performance in order to mitigate that lack of data at the on the balance sheet and the profit and loss level and others. So always think there has to be data. It's not us. None of the people on the panel will take a risk or not. We just are fashioning data to provide a better, simpler, and more standardized image of the actual risk.
I would just say, John, building on what John's saying, is the bit of the call to action around that is, if we start with Europe, the data is opened up, right? So the technology is there. You can democratize data. There's with open banking, you can get access to data. There are third-party providers who are in this space. But I think it's also then thinking about kind of how credit has been assessed, how credit has been, even the collection side. So I think it's just also about thinking about it differently, right? Whether you're a bank, whether you're a company, is actually, forget about kind of the traditional ways, because the traditional ways never facilitated a cost to serve model for large banks to service this segment, and two, there was no access really to performance history, because really you were just looking at the transaction history, in terms of credit assessment. But now actually, if you integrate and work with platforms where you're actually looking at the whole supply chain from start to finish, all the performance trading history is there. You overlay that actually getting access to the payment history, and then you can embed the collections directly through these platforms, right? So you're managing the collection risk out of that. So we see it. I think we just need to get, from a mindset standpoint, is almost just, this is the future, and what do we need to do to actually enable the future? Data is there, technology is there. We've got to all start thinking about applying it and working together and digitally creating that connectivity.
I think from my perspective, we do have already some interesting solutions which are trying to take the credit risk a bit out. One is dynamic discounting, which is obviously helping suppliers to get paid earlier, but obviously from the buyer. As soon as this is possible, that is a very smart collaborative way of doing it. Actually, it's the cheapest way for trade finance corporates. Just simply be collaborative between buyers and suppliers. That's from my perspective, it's the first low-hanging fruit. And obviously this requires a certain relationship between those trading partners. That has been around the block for a while, and has been actually a growing market segment. And then obviously then it could be that liquidity is not sufficient. And then we need a third-party funding provider, which is a financial institution, which is most likely then getting into a supply chain finance, receivables finance mechanism normally. From my perspective, it would be nice to actually work again with negotiable instruments because they're abstract to the trade transaction. From an investor perspective, very important. Although they relate to the trade transaction for various reasons in terms of categorization of the transaction as a trade transaction from a banking perspective, but also from an accounting perspective, from the buyer side to maintain AP status. But it enables an abstract instrument which is not diluted by disputes on the trade transaction itself. It takes away a lot of operational risk of also extracting data out of subledger systems, which nobody really wants. Any transactional system is normally holy and try to be ring-fenced and to be secure. And that is something which also enables then, in the second step, a distribute to originate model, or originate to distribute model, sorry, meaning that the first taker, the first bank can actually resell it to a larger pool, a larger portfolio, which leads to higher diversification, which then again in turn enables underwriting of transactions that might be of higher risk, but in the overall portfolio context are actually calculatable. You can calculate them into a risk-adjusted return basis. And that's my perspective on that question. But again, look at first collaboratively, dynamic discounting can be a perfect solution. You disintermediate sometimes the financial institution in this context, but it is something that is probably very smart. And then the second piece I just outlined.
Someone would like to give your perspective on that?
Well, I don't know much about credit, as we don't lend any money, but we certainly generate trade receivables, within the fund. But also, I think again coming back to there's a general theme here about data and transparency of data. Certainly, I've been on a few calls with ICC and also World Bank discussions around, what data should people be collecting from SMEs, and what data do people collect from different industries around the financing and movement of goods around the world, and then how that can help, for the bigger picture of financing and liquidity into the space. Certainly, we've been able to work with some trade receivable financing companies around reverse supply chain. So that's where, being a professional, neutral principle in the middle between suppliers and buyers, we're able to hopefully also add some balance sheet relief to the end buyers by, the reverse supply chain and receivables companies being comfortable dealing with us as a sort of an independent party there in the middle, but with our interests aligned, controlling and monitoring the goods and the flow. So I think it's interesting, but ultimately I think it's about, as John said, sort of standardizing, collecting the data. It comes down to sort of along the lines of open banking and allowing our SMEs to be able to share that data. And obviously, if one of our SMEs said, "Hey, we're trying to get this banking relationship going. Will you share? We've been dealing through you for 18 months, and we've done 50 cargoes, and we've performed well. Can you share that information with the banks?" We'll be happy to do so, because we see that we can add value to the banks by holding and monitoring the physical commodities, which is much harder and less of an advantage for the bank to own or have liens or security over the commodities themselves these days. So I think, there's no one single solution. And I think, all the panelists here have bits of the jigsaw puzzle. So hopefully, I think, it comes down to data openness and cooperation and collaboration, I think, for the years ahead.
Thank you, Tom. Well, we still have 5 minutes before we end the session. I'd like to perhaps ask a question, and maybe we could be very briefly and use this question as closing remarks, if you agree. What are the additional challenges and efforts that we should be looking at in developing markets to enable access to finance? are those critical? How can global organizations work together to address those challenges? And in terms of the upcoming years, how do you see this playing around developing countries? Because we know that much of the trade finance gap is in the global south. So I'll perhaps suggest you maybe to summarize in 1 minute. I know it's a challenging question, but maybe if you could, all of you, summarize in 1 minute before we end the session.
Okay, well, if I may, since I was the first on the previous questions, very simply, if it was a simple question of risk versus yield, we wouldn't be here. The problem is funders cannot measure the risk in emerging markets properly, and therefore, if you just put a yield 10%, 2%, it's meaningless. It doesn't work. Because yield without risk is not an equation. And so measuring the risk in emerging markets is a critical point, and standardizing around key variables is what we as TITUS do. The more transactions one puts in, the more you standardize. But think of your credit cards. If your credit cards are based, they're completely, there's no collateral to credit card loans, okay? Even in the West, it's the same, and the measurements is done through credit agencies. And the credit agencies have your past history. Everything is standardized. There are multiple credit agencies, there's not only one. You need to think of that mindset as emerging markets to standardize and get the transparency. And that's what we are here to do ourselves as TITUS, and I suspect everyone on the panel. Standardizing, transparency, data, that's the key. Thank you.
Thank you, John. Claire, over to you.
Yeah, look, nothing more significantly to add. I think John just touched on a point around, I think it's really about, particularly for SMEs, is matching the financing with their receivables flows, right? So, and that's why trade finance is so important. You think about, as opposed to kind of more long-term loans, and democratizing that access to data is also going to take for the companies themselves to allow access to the data. I would just add one more thing for emerging markets, is cooperation also with the multilateral banks, right? In terms of, we're working with a number of them on sponsoring some programs around kind of facilitating SME financing. But also, there's within that as well, you get the ability to partake in risk participation as well.
Thank you, Claire. Frank or Tom? Frank, please.
Sure. I think from my perspective, it's absolutely, I can only concur with John and Claire. The data issue. The other element is maybe I would like to see from the ICC something, the uniform rules on electronic trade transactions to be expanded to an industry standard on electronic negotiable instruments. The reason I'm saying this is because, yes, you have an instrument that is transferable or endorsable, we can allow to create larger portfolios. And then similarly to the analogy of John, I think to credit cards, trade finance always has been extremely risk averse and very conservative, transaction by transaction by transaction. And I think if you look at the credit card or student loan portfolios on a big level, you actually already calculate a loss of 4 or 5%. And we need to get to this risk-adjusted return approach. You need to expect losses, but you have a portfolio that is diversified and can carry those losses comfortably. And that is meaning you need an instrument, you need an infrastructure that allows the negotiability to happen within seconds and not through a normal receivables assignment process, which is extremely complex, especially if you think about globally. So we do need, in that sense, also an infrastructure that facilitates risk diversification, which is in the end at the core of any financial system, and actually the purpose of a financial system is to diversify risk. And that's what we need to get to in trade finance. And then I think we can really great success and expansion in an area of the world economy that is actually the lowest risk, in my personal opinion, because you have true value creation happening. And it's not a bubble where you get liquidity into areas of stable coins, etc., where there's no value creation. And we need to divert this stream of liquidity into the real economic activities. But we need an infrastructure.
Thank you, Frank.
Well,
Tom, over to you.
I think, yeah, so I mean, I think what everyone is talking about is great. I mean, the two areas where I think is really has been alluded to in terms of standardization, but also adoption of regulations or standard processes and procedures, acceptance of the electronic documentation within law. I mean, we can handle it at the moment through commercial contracts, but then again, it's much easier if it's already in law, like Frank said about Singapore with the electronic act there as well. And then we have also enforceability. So I think, this is something which, we can't do. I mean, this is really government to government and even ultranational groups to promote the adoption and the support of the enforceability of these regulations and approaches, because that's a big thing for lenders. I mean, that's why we took the approach of owning the asset, controlling the logistics, because you might like the SME, you might even want to lend money to them, but they're just in the wrong jurisdiction and you're just not comfortable to lend directly to them. So these are areas still to be worked on, I guess.
Thank you, Tom. Definitely well noted for the role of the ICC and other global organizations on actually providing those global standards and enforceability, of course. So we're definitely working on that, especially in developing markets where we just launched the Centers of Entrepreneurship. So we're looking for ways and policies and tools as well to enable speed access to finance and trade finance, of course, to SMEs in developing countries. I'd like to thank all panelists for this great discussion. I think I learned a lot with all of you. I'm confident that all people attending as well. And thanks a lot, and looking forward to the next steps of this conversation. Thank you.